Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Much busier week this week after a very slow week. Last week, obviously, the long weekend holiday, but lots happening. First off, the Bank of Canada coming out with their rate decision, and then, of course, the Vancouver real estate stats, put that all together. If you want the cumulative report on Vancouver real estate, the Saretsky report for August 2019 is now available. There's a link in the description below to that report, which is basically going to summarize everything in this video as well as all the charts and graphs. So I highly encourage you to check that out. But I mean, let's start with the Bank of Canada's decision to hold rates firm where they are. Not overly surprising, but I think what is surprising is they didn't really set the markets up for an obvious cut in October. So right now, market odds are now pricing in after the Bank of Canada's relatively hawkish statement. There's about 50% odds that the Bank of Canada will cut rates in October. Of course, if you've been watching these videos, my belief is that the Bank of Canada's hand is ultimately going to be forced, whether or not they like it or not or want to move. But what I do almost commend Pelot's is that if you read the monetary report that they released, the statement that they released, they actually cited part of the reason for being cautious about cutting rates was basically they're concerned about household debt. And obviously we very well know that, you know, household debt is arguably in a bubble here in Canada. There's so much household debt and house prices are obviously elevated that the Bank of Canada is very concerned about potentially re-stimulating that phenomenon through lower rates. But I think at the end of the day their hand is going to be forced as every single central bank cuts rates. Cumulatively today we have 17 central banks that have slashed interest rates this year, that without a doubt rate cuts are coming to Canada. I think that the BOC is just trying to give them enough ammo for the next recession, trying to delay as long as possible, but I still think they're going to get in a rate cut here this year. I'd be surprised if they didn't move in October, but I was, to be honest, been a little bit surprised of how the Bank of Canada and the econ data coming out of Canada continues to be relatively, I mean, significantly stronger than the rest of the world. So kind of definitely a bit of a head scratcher. It's not as if Canada seems almost exempt from global forces at this moment, which we know won't be the fact for very long. But regardless, you know, moving into the Vancouver real estate data, despite the Bank of Canada not cutting interest rates, the reality is households have already received the stimulus through lower rates, i.e. through the plunge in global bond yields, which has absolutely driven down, you know, your Canada 5-year mortgage bond, which has absolutely collapsed. That's allowed the stimulus through lower rates already, through people borrowing through mortgages. That's provided some stimulus, and so we're seeing an uptick in activity, not just in Canada, but in the US and Australia. You're seeing globally an uptick in housing activity, and that is basically through the drop in global yields, which has allowed mortgage rates to fall. And so all we have to do is look at the Vancouver real estate numbers. Definitely signs of picking up. It's the second consecutive month of an increase on a year-over-year basis. Now, again, it's important to understand that the context here is everything. Okay, so when you read these numbers and these headlines, you have to have context behind them, and you have to understand how the numbers get to where they are. So all we have to do is let's start with the detached housing market. If you read it, Greater Vancouver detached sales jumped 25% year over year. So most people are going to look at that and say, oh my gosh, the housing market must be absolutely on fire, 25% year over year. But if you look at sales cumulatively for August, they're still well below the 10-year average, and they're still well below, you know, even the averages, the 19-year average dating back to the year 2000. So detached sales are still extremely weak, but they are showing certainly signs of picking up. But inventory levels are roughly in line with they are. And so we saw the home price index for detached is down, I believe, 9.7% year over year. Now, again, most of that weakness is concentrated. It's becoming more obvious that it's concentrated at the higher end. And you're seeing a little bit of price stabilization in the sort of the lower end entry-level detached home is certainly seeing an uptick in activity because fueled with these lower rates and fueled with the fact that homeowners or households still have full employment today, you're able to basically go ahead and borrow at 2.6%, which is increased purchasing power, as well as the steep drop-off in prices over the last 18 months has certainly increased purchasing activity. And we can also see that in the condo market. Condo sales are actually right along with the 10-year average for August. So we basically saw, I would say, quote-unquote, a normal August. So you saw an uptick in sales. And if we look at it, the months of inventory, which is basically an indication of how much supply there is, the condo supply currently sits at 4.6. So the month of inventory for condos at 4.6. That's actually considered balanced. So it's really hard to see a whole lot of downwards pressure on condos if you have a sort of a low inventory base. Now, again, that inventory has increased, but if sales increase to offset that, then it keeps the months of supply relatively in check. So it's still in check at 4.6. So that's why we saw condo prices, as per the MLS benchmark, were down 7% on a year-over-year basis. But again, if you look at sort of other metrics, average price per square foot, median sales price, etc., we are seeing signs of stabilization for prices in the condo market. But again, when we look at all these stats and graphs and data, and you're analyzing it on a monthly basis, it's important to understand the larger picture. And the reality is that we have certainly, without a doubt, seen a stabilization and an uptick in activity in the Greater Vancouver housing market, but not just Greater Vancouver, but just housing activity generally across a lot of property markets globally. And this is, again, because of the lower rates. But this is not to say that we're certainly out of the the correction is over and we're going to make newer highs from here. The reality is in Greater Vancouver, you still have 45,000. It just hit another all-time high at the end of July there. 45,000 units under construction in Greater Vancouver. Obviously, that is a headwind moving forward. So when you see 4.6 months of inventory, that 45,000 units is going to be eventually, over time, add to that inventory supply, and that should alleviate or at least put more downwards pressure, you would think, logically, on prices. But I also think it's important to contextualize where we are in this moment in time. Is I had a client, reach out to me, and he's bought in this market, and so he actually, owns multiple properties, but he's extremely bearish. He says, there's no way this correction is over. Look at the fundamentals. Everything screams that this market is still overpriced, and it just doesn't make sense. If you look at it, price to income, price to rents, there's just no way that it makes sense. But as I said to him, I definitely agree with you and what you're saying. I mean, I've been doing these videos for the last 2.5, 3 years on the same premise. But the reality is the whole. I was like, we also have to extrapolate out into the whole market and say, what is the alternative, and is it just Vancouver real estate that's distorted, or do we have massive distortions in the bond market? You mean $16 trillion of almost $17 trillion now of negative yielding debt, negative yielding bonds in the global economy. So the fact that you get a better yield on a U.S. bond than a Greek bond logically makes no sense. But that's the reality that we're in, because central banks have manipulated markets to such a degree. The stock market, is basically exempt from any sort of weak economic data. So you can say, well, that doesn't make sense. Price to earnings. There's this bull market that we've been on. That doesn't make any sense. So there's so many distortions, and what I encourage you to check out is an interview below. I'm going to link to that as an interview to Macro Voices. They recently interviewed Grant Williams, who I'm a huge fan. He's the co-founder of Real Vision TV, which I've mentioned many times. I subscribe to Grant's newsletter, and just the conversation was truly amazing. And I think it really contextualizes this environment that we're in, that basically the safe assets historically, i.e. bonds, have almost become the risk assets, meaning that, okay, if you get, recession or, the flight to safety, normally speaking, is you exit out of stocks, you exit out of equities, and you enter into the bond market. But when the bond market's already giving you a negative yield, do you buy a negative 0.5% yield in Europe and hope it goes to negative 1%? I.e., you're basically looking for a greater fool. So you're locking. It's like a guaranteed loss, but you're hoping to basically resell that at a higher valuation, because again, you have to remember that as the yields drop, the prices rise. So basically what they're saying is like the safe asset is almost no longer the safe asset unless you believe yields can go to -1, -2, -3, -4%. Then of course it's, you can argue that that is still the safety play, but nobody is sure, because the rules of the game have changed fundamentally. And nobody really knows the rules because we're continuously making them up as we go along. And so that's part of my understanding, is that basically these distortions are going to continue, because what is the alternative to these distortions? If you get a complete repricing and restructuring in the bond market and the equity market, and real estate valuations come back down to where they should be, then everybody basically gets wiped out. And so that's why central banks have basically blown this thing up to where it's at, where there's almost like there's basically no recovery from that. So at the end of the day, that is how I'm approaching it from a value perspective, and sort of it's basically like, where do you put your money? And so that's how I'm looking at it. And it's funny because I always talk to people here locally in the Vancouver real estate industry, and they say, well, it's Vancouver, it's going to rebound, it's going to recover because of, the ocean and the mountains, and because we can't build anymore. And again, that's, in my opinion, an incorrect way of viewing it. I look at it fundamentally and saying the only reason why it wouldn't go through that substantial correction that it should is because the financial markets are manipulated, and there is no really safe haven to go to. So you almost have to basically funnel it into, say, tangible assets, real estate, and that's why I'm super bullish on gold. And not only myself, but Stan Druckenmiller's come out, Paul Tudor Jones, Ray Dalio, all single one of these guys are saying gold, gold, gold. And it's like, why is that? Because there's going to have to some sort of devaluation in the currency to basically keep this thing going. And central banks are going to have to get even more creative to essentially keep everything propped up, at least to the best of their ability. And this ultimately comes down to, are central banks infallible, and can they actually completely control financial markets? That's the million-dollar question. I don't think they can, but I also wouldn't be necessarily aggressively betting against them. So anyways, hope that video helped. I think there's a lot of things happening right now. I think Vancouver is clearly going through a stabilization. I think September, October will be relatively busy, or busier, than what we've been used to over the last 12 months. And I think that it's going to be anyone's guess, of course. If we get a recession and the layoffs come, then it's anyone's guess. And then it's going to be matter what happens as well in the bond market, because that's ultimately, people buy mortgage payments, they don't buy houses. And so as long as the yields are low, people have full employment, that provides the floor under housing. But again, those things can always change. So we're watching for those. That's why we do these videos every week. So hope that helped. Otherwise, see you next week.